Hello and welcome. Before we begin, I'd like to acknowledge that the material for today's explainer was prepared by Samir Al-Rashani with AI support. We're about to dive into a topic that really affects almost every single family here in Canada.
So let's jump right in. We're going to be talking about tax fairness for families and what that actually means in practice. Now, to be clear, we are not talking about finding sketchy loopholes or gray areas. Not at all. What we are going to do is break down the legitimate, well-established strategies that are already part of the Canadian Income Tax Act. Strategies that are specifically there to help families manage their tax bill in a smart, effective way. Here's a quick look at where we're headed. We'll start with the big idea, the core principle of tax fairness. Then, we'll get into the real nuts and bolts of splitting income with a spouse. After that, we'll look at planning for your children. And, of course, we'll have to cover some really important rules to remember before we wrap it all up with your key financial takeaways.
So let's start at the beginning. What exactly is this core principle that all these strategies are built on? Well, it's all about achieving tax fairness for the family as a whole. And the main tool to do that is something called income splitting. You see, here in Canada, we have what's called a progressive tax system. It just means the more you earn, the higher the tax rate you pay on your next dollar of income. So income splitting is simply the totally legal process of shifting some income from a family member who's in, say, a 45% tax bracket over to a family member who's only in a 20% bracket. And what's the result? Well, the family as one economic unit ends up paying a lot less tax overall. This is really a foundational concept in smart family financial planning.
All right, now let's get into the most common way this principle is used. Splitting income with your spouse or common law partner. We're going to walk through 4 really powerful strategies that you should know about. First up, we have CPP sharing. This is a really important one for anyone planning for retirement. It's a formal rule that lets you and your spouse actually share your CPP retirement pensions. And this can be a huge help, especially if one of you has a much larger pension benefit built up than the other. Now, it's super important to get this next part right. This is not something you just decide to do on your tax return. No, it's a formal application process. You and your spouse both have to be at least 60. You both have to be receiving your pensions, and then you have to fill out a specific application and send it to Service Canada. Once they approve it, they adjust the payments for you. And you can share up to 50% of the pension that you earned during the time you were together. Just imagine for a second. One spouse gets $1,200 a month from CPP, the other gets $400. By sharing, you can shift a big chunk of that income over. If one of you is paying tax at 40% and the other is paying at 20%, the savings on that shared money can be really significant, year after year after year. Okay, next up is the spousal RRSP. This one is just a brilliant long-term planning tool. It lets the person with the higher income make an RRSP contribution, and they get the immediate tax deduction at their higher tax rate. But the money goes into an RRSP that's owned by the lower income spouse. So you get a big tax break now, and the money grows until it's eventually taxed at a lower rate in retirement. Let's paint a quick picture here. Let's say spouse A makes $160,000 a year, and spouse B makes $50,000. Spouse A puts $15,000 into a spousal RRSP for spouse B. Right away, spouse A gets a tax deduction that could be worth more than $6,000. That's cash back in their pocket this year. Meanwhile, that $15,000 grows and grows, tax deferred. Fast forward to retirement, spouse B starts taking the money out and pays tax on it at their lower rate. You see, it's a win on the way in and a win on the way out. Our third strategy is pension income splitting. Now, unlike the CPP sharing we just talked about, this one is super flexible. It's a choice you get to make every single year when you do your taxes. You just fill out a form, the T1032, and you can allocate some of your eligible pension income over to your spouse just for that one tax year. But here's a detail you absolutely have to know. The key word is eligible pension income. And what counts as eligible really depends on your age. If you're under 65, the rules are pretty tight. But the moment you turn 65, the definition opens right up, and it includes withdrawals from an RIF, which is where most Canadians hold the bulk of their retirement savings. And look, there's that powerful 50% figure again. You can split up to half of your eligible pension income each year. And that year-to-year flexibility is fantastic. It lets you fine-tune your family's tax situation annually based on whatever else is going on. And finally, let's talk about the tax-free savings account, the TFSA. The rule here is simple. You cannot put money directly into your spouse's TFSA, but You can absolutely give your spouse money as a gift, and then they can turn around and contribute that money to their own TFSA. Because everything inside a TFSA grows and comes out tax-free, those attribution rules we're going to talk about soon, they just don't apply. It's a really simple way to help your family max out its tax-free investment space.
Okay, so we've spent a lot of time on spouses. Now, let's broaden the conversation and look at tax planning for the next generation, your kids.
All right, this next one is a huge opportunity, and honestly, it's one that a lot of people miss. It has to do with the Canada Child Benefit, or CCB. The government has created a very specific, very generous exception to the tax rules just for this money.
And don't just take my word for it. The CRA's own language on this is crystal clear. So what does this mean for you? It means you can take those CCDB payments, open a separate bank or investment account in your child's name, and put the money in there. And then all of the income it earns, every penny of interest, dividends, or capital gains is taxed in your child's hands, not yours. And for a child with no other income, their tax rate is basically zero. Now, for any other money you might give to a minor child, the rules are split and you have to be careful. Let's say you give your 10-year-old child $20,000 worth of a bank stock. Any dividends that stock pays out each year get attributed back to you. You have to report that income on your tax return. But let's say 5 years later, your child sells that stock for $30,000. That $10,000 capital gain, that is not attributed back to you. It gets taxed in your child's hands. This makes investments that focus on growth rather than income a much smarter choice for these kinds of accounts.
Okay, so we've talked about all the great opportunities. Now we have to talk about the guardrails. It is absolutely essential that we understand the fine print of family tax planning.
So what are these key limitations? What are these attribution rules that I keep mentioning? Paying close attention right now is what keeps you on the right side of the CRA and makes sure your planning is sound. Okay, 3 big ones to remember. First, when you give property to a minor child, the income attribution rules generally stop once that child turns 18. Second, be careful with loans to adult children. If the CRA decides the main reason for the loan was just to help you pay less tax, they can still apply the attribution rules. And third, a big one for spousal RRSPs, the 3-year rule. Basically, if you contribute to a spousal RRSP this year, any money your spouse takes out this year, next year, or the year after gets taxed back to you, the contributor. It's there to make sure people are using it for long-term retirement planning, not as a quick-fix income split. All right, let's pull all of this together and wrap up. This last section is all about what you do with this information, how you put this knowledge into action. So here's the bottom line. For spouses, you have this amazing toolkit: CPP sharing, spousal RSPs, pension splitting, and the TFSA strategy. Used together, they can help you balance income right through from your working years into retirement. For your children, investing the CCB is just a fantastic, tax-smart gift you can give them. And it's so important to remember, these are not tricks. They are established legal provisions in our tax code. But the real key, the most important takeaway, is that these strategies work best when they aren't just one-off decisions, but are woven into a comprehensive long-term financial plan.
And that really brings us to the final question, the one I want to leave you with. As you think about your own family and your own goals, which of these legally permitted tools could you use to strengthen your family's financial future? It's a really valuable conversation to start having. Thank you so much for your time today.